During the European sovereign debt crisis, a dangerous feedback loop emerged. Weak public finances hurt banks that held large amounts of domestic debt. And weak banks in turn increased sovereign risk. This doom loop between banks and governments has haunted European policymakers ever since. The question is more than academic. Despite major institutional reforms, this home bias, the tendency of banks to hold domestic sovereign debt, is still high. The level at this moment is about 70%. Why does this dynamic persist, and what are the impacts and the consequences on the European economy? In our recent research, published in the Banking Supervision Working Paper series, we examine the effect of reliance on domestic banks for sovereigns. We test whether governments become more complacent or are pushed towards fiscal prudence when the home bias is higher. Our answer is that it depends. It depends on the level of the home bias and on the financial structure of the country. To analyze the effect of home bias on fiscal policy, we assembled a dataset comprising 27 EU member states between 2001 and 2022. This is a combination of the IMF's dataset on sovereign debt holdings together with an EC macro dataset. The results reveal three main insights. First, governments can actually smooth out economic shocks by placing additional public debt with national banks. The second insight, however, is that the effect depends on the financial structure. In particular for those countries with a low level of financial development, mostly outside the euro area, placing public debt with national banks is not easy. So they have to resort to fiscal consolidation measures quickly and cannot smooth out economic shocks, while at the same time public debt is at danger. Foreign bank participation tends to discipline governments by diversifying debt placements, and so limits pressures on domestic banks to take on additional public debt. State-owned banks, on the other hand, tend to soften sub-budget constraints and let governments push for additional public debt with these banks. What are interesting takeaways for banking supervision? First, the risk of excessive build-up of public debt in the national banking system depends on the level of financial development, with more risk when the banking market is less developed. This is of course particularly the case outside the euro area. The levels of home bias also do not have to be extremely high in order to create such feedback loops. A second finding for supervisors is that the presence of foreign banks that reduces risk, or the presence of public banks that increases the risk, can have a different impact across EU member states. In sum, our results indicate that when deeper and more integrated financial markets are in place and cross-border banking across Europe is encouraged, the risks of a higher home bias are limited. Such configuration can also create fiscal space without increasing financial fragility across Europe.